Good morning, everybody. It's August 18th, Monday, August 18th, and aren't we just having loads of fun? So many interesting things to keep on top of in this business. There's never a dull moment in our business. Sometimes I think we all wish there were some dull moments. Maybe this week will be a little dull because there isn't much in the way of economic indicators. But then again, on Friday, the Fed chair is going to speak at Jackson Hole in the Grand Tetons National Park there. And everybody's waiting to see what he's going to say. Will he be a dove? Will he be a hawk? Will he be an owl? Just kind of sitting there looking at the data to decide what to do next, whether to be dovish or hawkish. Will he sort of cave into all this pressure that the president has been putting on him, even to the point of threatening that the president, I think, threatened Powell with a lawsuit with regards to his handling of the construction of the renovation. Anyways, it's been pretty ugly. A lot of heckling, a lot of bullying from the White House, not just from the president, but obviously there's been an attack on Powell. So we'll see if whether he flinches or not, or whether he responds to that by being even more hawkish. My thinking, he's going to be owlish. He's going to say, look, we're still data dependent. We had some surprisingly weak labor market indicators. On the other hand, we are seeing some signs that inflation at least isn't coming down to 2%. Seems to have stalled around maybe 3%. I don't know if it'll be quite that precise, but that's kind of my assessment of the data. And he might say that we're going to, before the next meeting, we're going to have a couple of inflation reports. We'll have the PCED for July, the consumption deflator inflation rate. Looks like that'll be a little bit hotter than it was the month before. The reason for that is some of the components of the PPI go in there, and the PPI was up 0.9. It wasn't as bad as it looked. Some of that was portfolio management fees, just reflecting a stock market being higher and maybe the fees being higher. So don't want to exaggerate that PPI number. But I think he'll say that he wants to see the PCED and then the CPI number that will be released next month before the FOMC meets on September 16th through 17th. So I think he's going to. Oh, that's weird. Somebody's hearing some music. I just looked at a note. I'm not hearing any music. It says, is the music part of today's chat? Not to my knowledge. Let me know if anybody else is hearing any music, because I'm not hearing any music on my end. Okay, we'll see. Anyways, if you are not hearing anything, no music. Okay, so maybe somebody's got music channeling in at the same time as we're doing. I got it. No more. Thank you. No music seems to be the consensus. Maybe music is something we should have on TV programs. Have music to highlight their dramatic effect. So maybe we should do that as well. But anyways, let's not get too dramatic here. I think either way, whether he's owlish, dovish, or hawkish, if the Fed does go ahead and lower the Fed funds rate on September 17th, it'll probably be because the next batch of inflation numbers turn out to be sort of a non-event. And the key number, I think, clearly, I mean, those are key numbers, but just as important, maybe more important, will be the employment number report that we get at the beginning of next month for August. Now, I do have a annoying tendency to see the positive things of the side of things, half full bottle glasses kind of person. And the way I'm looking at it, May and June, yes, they were revised down sharply at over 250,000, and I think May was like 14,000 employment, and June was about 19,000. I may have them reversed. But then we saw that July went up to 73,000. So, 73,000 is pretty weak, but it looks pretty strong compared to what we had in May and June. If I'm right, that a lot of the weakness in employment in May and June might have had something to do with the uncertainty related to tariffs. If I was an employer, I wouldn't fire anybody, but I might hold off on hiring until I figured out how these tariffs were going to play out. And I think the way it's played out is, the president's going to turn out to be relatively flexible on these things. There'll probably be a 10, 15% minimum tariff and some other tariffs along that. And then the courts may rule that he doesn't even have the power to do all that. So I think a lot of us that are in business are just saying, you know what, let me just move forward and just assume that all these things will work out one way or the other. And meanwhile, I got to get along with my business. I need to hire some people. So I will not be surprised if the August number is 100,000. Now, 100,000 isn't a lot, but it's better than 73,000. It's better than 14,000, 19,000, which is what we had in May and June. And it would sort of kind of give some credibility to my notion that maybe the labor market's just fine and it weakened for good reasons, but it was temporary, and now we'll see some hiring going on. The JOLTS data, the consumer confidence data, all that suggests that the labor market still okay. It's not suddenly getting stronger, but it's not suddenly getting weaker either. And of course, the initial claims confirm that layoffs remain extremely low. The problem in the labor market seems to be the duration of unemployment, especially young kids coming out of college. Even high school kids are finding that it's taking longer to get a job. So the longer it takes to get a job, the more people kind of pile up there in that pool of unemployed. And that is something to be concerned about, but is it something the Fed can really do much about? What if a lot of that has to do with automation? You walk into a Shake Shack these days and you don't have a lot of people working there anymore. You've got iPads. You come in, you put your order on the iPad. You take a number, put it on your table, and one person comes out when it's ready. So they've really cut back the kind of staffing they need in restaurants. And then anecdotally, we are hearing that AI is certainly having some impact on the demand for software coders, for example. But as companies are trying to figure out how they can use AI, maybe they're holding off on hiring until they figure out whether some of what they want done can be done by AI software and technologies and just make your current workforce more productive. So that some of that may be going on. And we also know that there's a supply side issue. It's a lot of moving parts. And that's why it's kind of interesting and it's good that the Fed's conclave there in Jackson Hole later this week, is in fact focusing on the labor market, all the crazy changes going on the demand, supply, productivity, and so on. So maybe we'll get some insights from some useful papers there. But of course, the main event will be Powell speaking on Friday. And again, I think he's going to be owlish. He's going to say we're data dependent. We'll have to see how the next two inflation numbers look, how the next labor market. But he'll say we're not, a rate cut certainly is on the table and it's possible. And we'll see where it goes from there. So I don't think we're going to know a lot more than we know right now. And I think the market may just kind of churn around a little bit for the rest of the week until we figure that out. Now, of course, there's going to be other talking Fed heads out there. There's going to be Bauman and Waller. They're also going to be giving speeches. I think it's actually in Wyoming. There's a symposium on, I think it's on blockchain of all things. And of all things, two Fed governors were invited to speak there and both agreed. I guess they figured why not make it a long visit out there in the Jackson Hole area. And so we know that they are the dissenters. We don't know whether Steve Murrin is going to be confirmed by the Senate fast enough to be in attendance at the September 16th, 17th meeting. He might be. So there might be three dissenters if the Fed on balance decides not to lower interest rates. But right now, my view is a contrary view. the widespread view is, I think last I saw was 90% probability that there'll be a rate cut by the Fed. The risk the Fed is taking is the same, is kind of a replay of what we saw at the end of last year. Last year, the beginning of last year, we said the Fed doesn't need to cut rates. We were in the none and done school camp. We were wrong. The Fed cut by 100 basis points, but then we were right because we said economy didn't need it, and the bond yield might go up on it. And sure enough, the bond yield went up 100 basis points. The 10-year bond yield went up 100 basis points on the Fed cutting the Fed funds rate by 100 basis points, and the mortgage rate went up. And here, the administration, the president would like to lower interest rates aggressively, quickly to bring mortgage rates down. He'd like to do the same to refinance the debt at lower interest rates. But there could be a perverse reaction by the bond vigilantes, where the bond vigilantes said, we don't get it. We don't see any particular reason why this Fed rate cut is actually warranted, especially if the inflation numbers come out a little hotter than expected and the employment numbers come out stronger than expected. And if they still go ahead and cut the Fed funds rate in that situation, the bond market might protest. Stock market might figure out heads we win, tails we win. If the economy is better than expected and inflation's a bit hotter and the Fed doesn't cut rates, who cares? Earnings are looking great. 2 quarters in a row where earnings beat significantly. And then the market might say, economy is resilient, and might agree with us. If the more that the market agrees with us that the economies are resilient and the chances of a recession are fairly low, the more that these high valuation multiples are in fact sustainable. It's recessions or fears of recessions. Fears of recessions cause corrections that mean that the PE takes a dive, and then the recession doesn't happen and the PE rebounds. We had two experiences here with the market taking a dive. The latest one was the one at the beginning of the year, and the PE got down to 18. Then before that, we had a sell-off where the PE got down to 15. So that tells me that the market may be getting more and more used to the idea that it's not a good idea to bet against the economy. It might be resilient, and PEs may actually hold up. Now, clearly, the PE is very high at 22.5 forward for the S&P 500, but we know that a lot of that is a Magnificent Seven, and the 493 are selling at a PE about 19, so they're not dirt cheap. But there's still probably some room for them to either stay at 19 or go higher. And the stock market outlook, I think, is still a positive one to the extent that the economy remains resilient and that the earnings surprises continue to be on the upside. Well, we can all look at that in a second. If you read my morning briefing today, you notice that I said that I'm disappointed. I'm disappointed that I'm not on the short list to be at the chair of the Fed. I've been doing this for over 40 years. I've been a Fed watcher. I worked at the Federal Reserve Bank of New York. I wrote a book called Fed Watching for Fun and Profit. Well, so much for my resume, making me a candidate. What disqualifies me automatically is that I'm not favoring a rate cut under the current circumstances. But anyways, I really enjoy this job. I enjoy doing this. I like the freedom of being able to work from home, and I don't think they'll let me do that. So one of my preconditions for accepting the job, if it was offered, is I'd want to work from home, and I'd save the Fed a lot of money. I think I could cut the budget by about half, and if I can do that, well, maybe they don't really need to do those renovations at the Fed. Maybe they could change the plans and make them into condos, which is something I think the president would be delighted to see happen. But anyways, let's get serious here and look at the important stuff that matters to all of us in the markets here. So let me share my screen here, and here we go. Showtime. So my son David and I put together this chart this morning, and it was inspired by a chart that a fellow by Trahan. Trahan used to be over at Bear Stearns. Now he's got his own uh, consultancy, but I don't think he's doing what we're doing. He's actually offering sort of like a CFA for macroeconomics. So sounds like a good idea, and we wish him well. And he does post on LinkedIn, and thought this was kind of an interesting chart because again, even though the CPI wasn't terrible, even though the PPI was terrible, but when you look more closely, it wasn't that terrible because of that 5% increase in portfolio management fees. That doesn't mean that we're out of the woods on the inflation effect of the tariffs. And this is the chart that we duplicated here, so you can see the ISM prices paid in manufacturing plus non-manufacturing. So that's shows you what purchasing managers saying are happening to their prices paid. They don't track of prices received, so prices paid is what they have. And then the PPI for final demand, year over year percent change. I mean, the correlation here was spectacular with the benefit of hindsight. Not that great, but the waves were kind of coincident. And here it's the correlation again, not perfect, but the trend has been to the upside. And now we've had this spike here in the combination of the prices paid by manufacturers and non-manufacturers. And so that augurs not too well for the PPI up ahead here. So again, we'll see how that plays out. I think a lot of product was brought in maybe before the tariffs were implemented. They loaded up the warehouses with them, and now they're going to be selling the stuff at pre-tariff prices. But then with a lag, the tariffed goods are going to be affected. So let's see where we want to go next. Oh yeah, before we go to the chart package that goes in the morning briefing, this is an optimistic chart. Obviously, it shows you the S&P 500 operating earnings per share for the 2025 year, but quarterly. And this is the analyst consensus forecast. We monitor this every single week. And you can see that at the beginning of the earnings reporting season for Q2, the analysts were expecting about a 3.5% year-over-year growth rate. And now as the data has come in, it's coming in closer to 11%. It's kind of flattened out here. But obviously, we've had a lot of very strong surprises on earnings to the point where the second quarter earnings, which were kind of below all the three quarters, now are up above two of them. And this is reminiscent of what happened in the first quarter, right? We had the analysts looking for, what does that look like? About 6%? Yeah, 6%. And it was almost double that in terms of the growth rate, almost 12%. So there's an extraordinary resilience in the economy that's being demonstrated in the resilience of earnings. This is forward earnings, so we're looking now at the four quarters. Instead of the four quarters, we're looking at the analyst consensus expectations for the current year. That's this one, and for next year. And you can see that the tariff turmoil caused them to lower their numbers. Now, as that turmoil seems to be abating, we've seen some pickup here. Again, thanks to the actual realization of profits being better than was expected in the face of all this. And forward earnings have gone up to an all-time record high. Keep in mind, we're still shooting for $300 a share by the end of the year, and you put a 20 multiple on that. And so $300 a share would be what the analysts are expecting for next year, right? So the market discounts, it's forward looking, so it would be looking at analyst expectations of the 300. If the PE were 20, that would give you 6,000 on the S&P 500, which would be down from here. Put in 22 multiple, and you get 6,600, which is, we've kind of gradually edged up our number to 6,600. In a melt-up situation, which I think is something that would be quite conceivable, I mean, it kind of feels like a melt-up now in terms of valuation multiples. But I think if the Fed were to, in fact, lower rates on the September 17th meeting, then we probably would be looking at 7,000 on the S&P 500, something more like a melt-up situation. Well, let's go back to this notion that recent history suggests that if the Fed were to cut rates, that might not be so good in terms of the reaction of the bond market. And so kind of beware of what you wish for. This, by the way, is a chart of the U.S. Citigroup economic sentiment indicator. And so it's basically is the macroeconomic indicators weaker or stronger than was forecast by macroeconomists, I suppose. And so you can see that the CESI back in 2024 in the spring and the summer kind of took a dive. And then once we get into the fall, this is September 19th, I think it was, when the Fed lowered the Fed funds rate, then did it again and again, 100 basis points. And I guess they were kind of reacting to signs that the economy might be weakening. And instead, that turned out to be a soft patch, and the economy's resilience was demonstrated with the CESI. And the unemployment rate remained right around 4.1%, maybe 4.2%. And the bond yield did not respond well to that, as we'll see in a minute. But let's go there right now, as a matter of fact. So here's the Fed cutting rates late last year, and here's the bond yield in September going from about 3.6% to about 4.8%. That's the solid line. The dotted line is the 2-year. And then it's been kind of fluctuating around the Fed funds rate. Maybe I'm wrong. Maybe if the Fed funds rate's cut by 25 basis points, the bond yield will follow that. We'll be looking at 4%. And then the bond yield might be anticipating another quarter point, and we'll be looking below 4%. But we've been thinking 4.5% plus minus 25 basis points is kind of where the where the bond yield should be, and it's kind of been sticking there pretty well so far this year. But the year ain't over, so we'll see whether it continues to play out the way we've been thinking. But this is just another picture of the Fed cutting the Fed funds rate and the mortgage rate going up, along with the 10-year yield going up. The Fed officials have indicated that they would like to get rid of their mortgage-backed securities. They're still sitting on $2.1 trillion of mortgage-backed securities. They have been slowly paring that portfolio down, but that's contributed to widening the spread of the mortgage rate to the 10-year. It's narrowed some, but it's still figure about 100 basis points above where it had been, sort of at least in the history that we see in this chart. So here we had this important development where we had a weak employment report, and some of you may agree with me, some of you may disagree with me, but the market just seems to have the point of view that this is fundamentally weak data that should force the Fed to lower rates, even if some of the inflation numbers have been somewhat hotter. The Governor Waller's argued that a lot of the inflation that's caused by tariffs is transitory. Goolsbee is on the FOMC, has kind of responded by saying, well, if it was a one and done tariff, it'd be one thing, but these tariffs don't seem to be one and done. They seem to be sort of an ongoing story. And so that's kind of a counterpoint to the idea that it's just a one-time transitory effect on inflation. And oh, by the way, there's no doubt that tariffs have had an impact on inflation, durable goods inflation. That's quite clear. I think I got that here. I used to have it. I guess I don't have it here. We've looked at it before. The durable goods inflation rates come up a lot. But it's the services inflation rate that's become a little bit hotter, and it's not just rent of shelter. Rent of shelter inflation has actually been moderating, but a lot of the components of services on a year-over-year basis are still running between 3 and 4%. They're not coming down to 2%, which is what they were before the pandemic. And so we'll see again how that plays out. Meanwhile, valuation is high. There's no doubt about that. I mean, we got a record high in the Buffett ratio, and as a result, Buffett and his successors are looking for where they can find some value. They found some in United Health. They're not looking to buy highly priced stocks. They're looking for some good value, and that's where they found it. Then here's another slice and dice. This is again, I use the price to sales ratio as a Buffett ratio on a weekly basis, all-time record high of 3.1, and the forward PE at 22.5. So we've been here before this correction in the PE-led correction, and now we're back to where we were before the correction. The Fed has a history of lowering interest rates aggressively in recessions when initial unemployment claims are rising sharply. So, this is kind of a big mess here, but you can see that the blue line is initial claims. Initial claims go up, the Fed cuts. Initial claims go up, the Fed cuts. Let's go here. Initial claims go up, the Fed cuts. Ditto, ditto. Same here, and here, right? And now initial claims are doing nothing. They're just kind of sitting there. So does that really create an emergency situation where the Fed has to lower interest rates? Well, again, a couple of Fed governors, the dissenters, say, well, we want to get ahead of things. We don't want the labor market to slow, so we should be lowering interest rates. Of course, the president would like not just a quarter point, he'd like 50 basis points for starters and more to follow. He wants to get the Fed funds rate down to 1%. Good luck with that, I would say. The problem in the labor market, again, is not that people are losing jobs through layoffs. The problem is those who are unemployed are staying unemployed longer, and that could be people who are coming into the labor market for the first time, kids coming out of school that are having a tough time finding a job, and that's where the problem is. And maybe that justifies lowering the Fed funds rate to try to stimulate more demand so these folks get a job. Or maybe there's more structural issues in the labor market, and all you're going to do if you cut the Fed funds rate is get a melt up in the stock market. And by definition, melt ups are followed by meltdowns. And financial stability should be a concern of the Fed. I know it's not legally mandated, but I think financial stability should be important. Meanwhile, I should have mentioned the retail sales numbers. The retail sales numbers are really good numbers when they support our story. When they're not, they're going to be revised. The June number was revised from up 0.6, which is an okay number, to an even better number of up 0.9. And the July number was here at 0. Do I have it here? Yeah. Retail sales and food services up 0.5. So retail sales look fine. There's not a lot of distress showing up in the consumer and initial claims or retail sales. You can find, obviously, some of the delinquency rates and subprime auto loans and things like that. There's distress. But meanwhile, the Atlanta Fed's still showing 2.5% growth. Consumers on the light side at 2.2%. But we're thinking that as the uncertainty related to Trump's tariffs diminish, and as the labor market continues to look fine, as indicated by claims, that consumer spending will be just fine going to the end of the year. Here it is. This is what I mentioned. Sometimes I forget my own work here because we do so many charts and we do a lot of analysis. But you can see that this is a clear indication that Trump's tariffs had an impact in durable goods. This is all goods. So all goods have been brought up. That includes non-durables. So the durables has had an impact there. And the services inflation rate kind of flattened out here at close to 4%. So, if this was still deflating and this was 4%, maybe it would be closer to 2%. But our argument has been that tariffs didn't boost inflation. They kept it from falling from 3 to 2%. And that's our view of it. Shell again, these are the services inflation rates, and they are elevated. Service. This is the uh, so-called. Now I forgot what I wanted to so-call it. This is something that Powell has been talking about. CPI services less rent of shelter. Even that's up 4%. Uh, I think you call that the super core inflation rate. Then here's what I mentioned before. These are the various components, headline components, subcomponents of services, and they're hot. Education and communication isn't too bad, 1.1, but then medical care is 4.3, other personal is 4.5, recreation 3.9. I mean, these are not cool numbers. So it's not just rent of shelter, which is coming down. But we've got some others that seem to be kind of sticky up there. I think that's all I want to talk about on the charts. Let me do a couple of a quick Q and A's here. And let's see. So one of you folks was hearing music, and nobody else was hearing music. That's fine. What about the rising unemployment rate among college grads? Probably related to AI, but this is a concern yet. Look, I know this from my personal experience, family and the friends and otherwise. Yeah, a lot of college kids are having trouble finding jobs. That's because a lot of them studied our majors in business and communications. And what the hell is that? I mean, it's a very vague kind of soft topic. It's not something that lends itself to immediately, oh yeah, you're exactly what we want when they got so many people coming out with these kind of degrees. I think some of it is the kids just have spent a lot of time spending 250,000 to 300,000 or more without getting a focused education on where the jobs are. But now, as you say, AI has kind of complicated the situation even more. A lot of kids coming out of schools also said, I know exactly what I want. I want a job. I'm going to be a coder. I'm going to get into software. I'm going to go into computer sciences. And now they're kind of totally frustrated because those kind of jobs are being cut back. And it may not be that they don't need these people. They may, a lot of companies may just haven't figured out whether AI can replace coders. And if that's the case, why hire anybody until you figure that out? Brian, do you feel like the market is underestimating the risk that Trump's authority to implement tariffs could be overturned by the courts? You have discussed the topic regularly, but I have not seen it discussed elsewhere. Yeah, this is probably going to just be a shocker that comes out of the blue, and it could come out anytime. It could come out between now and the end of August. James Lucier, who's sort of our friend in Washington watcher down in D.C. at Capital Alpha Partners, he says it's probably be late September, but it could come sooner than that. And so the appellate court has to rule on whether the president has this authority. There's a good chance that they will rule against him. And then what? I pointed out that the administration sent a letter to the appellate court after they made their appeals saying, oh, by the way, if you blow us away, this will be a disaster. It'll bring in the 1929 Depression. I mean, it was a crazy letter. Lawyers sending judges these letters sounded a little bit kind of odd, but they did suggest that they don't really believe that the alternative ways to get tariffs are going to work for them. So it's either this or they got a major problem. Chip, rate decision is the threat of inflation for the middle and lower classes or a minor market melt up, meltdown for everyone else greater than the benefit of reducing the Fed's interest rate payments on its debt. Um, I don't know. I mean, I'm of the opinion that if the Fed cuts rates here when it's not warranted, that could create a meltdown situation. Uh, doesn't have, it's not doesn't have to be a bear market. Could be a correction that follows that, just more volatility. Uh, you know, not by the time we figure it out, it'll be too late to panic. That's kind of been my advice in the past few sell-offs that we've had over the past few years, that it's too late to panic. And by the way, that turned out to actually be right. So I would not worry too much about meltdown. I think we'll get through something like that pretty quickly. But for the economy, I think the economy is resilient. I think the inflation news is still troublesome for certainly for lower income people. Things are expensive, even for people who have the wherewithal. It's pretty noticeable that prices have gone up substantially. I'll take one last one here. Thanks for all your insights. What is your current end of year 2026 S&P estimate and range in year? Yeah, at the end of this year, we've kind of nudged it up to 6,600. Uh, haven't taken away the possibility that a meltup will get to 7,000. And so 6,600 by the end of this year is base case. And next year, 7,500. So that's about a 13% increase. And that's the story. Why don't we end up on that happy note? Have a good week. A lot of interesting developments coming out of the White House with Ukraine and Russia. We'll see how that plays out, but that's probably going to be a long slog from here. And meanwhile, we'll all tune in to Powell and see whether he's a dove, a hawk, or a an owl. Somebody said I should call him a mule, just kind of stubborn, but I think owl is more appropriate. Thanks, everybody.